In this video, I'll show you a simple two-fund portfolio that any Australian investor, including yourself, can easily set up to grow your wealth. Look, investing does not need to be complicated at all. Many new investors often overcomplicate the stock market and stress themselves out of doing anything. Or they believe that investing is exclusively for the rich people in suits who can professionally select stocks. If you also thought this, then don't worry, I used to think the same. But let me tell you a secret. Around 90% of fund managers and professionals fail to beat the portfolio I'm about to show you in the long term. Let's get straight into it. The funds, VAS plus VGS. The two funds in question are VAS and VGS. These are two very popular ETFs listed on the ASX that track several market indexes. You may have heard of the term index funds being thrown around. An index fund is a type of managed fund or ETF designed to replicate the performance of a specific financial market index such as the ASX 300 or S&P 500. In fact, Warren Buffett, who is considered one of the greatest investors of all time, suggests most people should invest in a low-cost index fund rather than trying to select stocks individually. This is because historically, 90% of fund managers and professionals are not able to outperform the market or index over the long term. In Australia, the best way to invest in index funds is through an ETF. An ETF allows you to invest in many companies under one stock. This means you can just invest in ETFs which will always contain the best companies now and in the future, instead of trying to predict which individual companies will succeed. As the ETFs we are talking about track an index, this index will only contain high-performing companies. Any underperforming companies are removed and replaced regularly with better performing ones. VAS and VGS are two popular low-cost ETFs that track the Australian and global stock market index. If you invest in VAS and VGS, it essentially means you are investing in the top performing companies in Australia and other developed countries such as the US, UK, and Japan. This ETF combo is a very popular choice in the Australian finance community, and rightly so. With these two ETFs, you basically get a piece of everything in the global stock market. VAS includes the top 300 companies in Australia, which makes up about 97% of the entire ASX. This includes well-known Australian companies like CBA, BHP, and Wesfarmers. For more information, you can visit the Vanguard website, which includes a concise 2-page fact sheet. I'll leave a link down below if you want to check it out. In fact, I'll leave a link to the fact sheet of every ETF I talk about in this video in the description. VAS has a management fee of 0.07%, meaning you only pay 70 cents for every $1,000 you invest. This fee is deducted from the share price, so there's no out-of-pocket expense. The fund pays a quarterly dividend and offers a dividend reinvestment plan, allowing you to automatically reinvest your dividends. This ETF will always contain the top 300 Aussie companies forever. This is because each company's performance is regularly assessed and underperforming ones are replaced. However, since Australia only makes up around 2% of the global stock market, there is a diversification risk if you only invest in Australia. That's where VGS comes in. VGS includes over 1,400 of the top companies from developed countries, excluding Australia. This includes well-known companies like Apple, Amazon, Tesla, and Toyota. The US makes up 72% of this fund, followed by Japan at 6.2%, then the UK, France, Canada, and the remaining developed countries. The management fee is slightly higher than VAS at 0.18%, which is understandable given the size of the ETF. Still, you're only paying $1.80 for every $1,000 invested, which is still relatively cheap compared to other managed funds that can charge 1 to 2% in fees. VGS is diversified into different sectors such as IT, financials, and healthcare, among others. It covers various sectors in the US, Europe, and Asia. And similar to VAS, only the best performing companies remain in this fund due to regular performance tracking. Let's check out the historical performance of these funds. VAS was established in May 2009, so it's been active for over 15 years. The 10-year average return is approximately 7.7%, and the 5-year average return is around 8%. So these returns have been quite consistent. But please note, these returns assume all dividends are reinvested. So the return includes both share price appreciation and dividend reinvestment. Also, when it says 8% return, it doesn't mean there's an 8% increase every single year. It's an average of 8% per year, meaning it could increase by 20% one year and decrease by 10% another year. But over the long term, it averages out to 8%. VGS was established in November 2014, so it's been around for nearly 10 years. The average yearly return since inception, which is essentially the 10-year average, is 12.7%. The 5-year average return is about 12.4%, so it has been consistent over the last decade. However, please note that these returns are not guaranteed. Just because VGS has averaged 12% over the past 10 years does not mean it will continue to do so for the next 10 years. It's important to understand this risk when investing in ETFs in general. Please remember, while we do hope for continued performance, past performance does not guarantee future results. So why these two funds in particular? Well, let me show you some advantages of investing into these funds. 1. Diversification. By investing in VAS, you are getting 300 of the top companies in Australia. There are no other ETFs that gives you this level of diversification. By investing in VGS, you get over 1,400 of the best companies from developed countries, in particular the US market, which continues to dominate the entire global market. Diversification usually reduces the risk of an investment, and investing into these index funds are a great way to diversify. Warren Buffett recommends most people should stick to index funds and invest in them consistently regardless of economic conditions. This is because over the long term, you'll receive the average return. Buffett believes that most people don't have the time to research stocks, making index funds a safer option. 2. Low fees. ETFs that track a low-cost index tend to have lower fees compared to other types of ETFs. For instance, VAS only charges 0.07%, while VGS charges 0.18%. The difference in fees may seem minimal, but consider this hypothetical scenario provided by Morningstar to fully understand the significant impact of high investment management fees over a 30-year period. Let's say there are two funds that yield the same annual return over 30 years. Fund 1 charges a 0.5% management fee, while Fund 2 charges a 1% fee. If you invest $100,000 in each, you'll find that after 30 years, Fund 1's final balance is $87,000 higher. Essentially, this means you would have paid an extra $87,000 in fees over 30 years with Fund 2. This example shows the extra money you could have made by choosing an ETF with lower fees. 3. Liquidity. I personally like VAS and VGS because they have the highest asset under management compared to other similar ETFs in the market. This means more people in Australia invest in them because they trust Vanguard. This makes the ETFs more liquid since there are more people buying them. So it will be easier to sell in the future if you ever need the money. 4. Simplicity. I appreciate the simplicity of a two-fund portfolio. Since your portfolio is only 2 ETFs, your only task is to invest in them consistently without the worry of timing the market or the stress of selecting individual stocks. In the investing world, particularly for beginners, the simpler it is, the better, because the average person is more likely to stick to a task if it's simple. 5. Australian domiciled. Both VAS and VGS are domiciled in Australia. While VGS invests in international companies, it remains Australian domiciled. This means it is taxed in Australia, which makes it easier for you during tax time. It also allows you to set up a dividend reinvestment plan, which automatically reinvests your dividends for you to accelerate your portfolio's compound interest. Please note, not all ETFs are domiciled in Australia. VTS, for example, is a Vanguard ETF that covers the entire US market, but is domiciled in the US. This complicates tax calculations as you'll need to consider the exchange rate among other factors. Also, you won't be able to set up a dividend reinvestment plan if the ETF isn't domiciled in Australia. Where to invest? To invest in these ETFs, you need to sign up to an online brokerage account. This is a place you can buy and sell shares and ETFs. Now, we have many decent online brokers in Australia, and they all work reasonably well. However, not every online broker was made equal. Some have better features than others. I'm currently using Moomoo because it ticks off 2 things I look for in a good Aussie online broker. 1. Share sponsorship. This basically means you own the shares you buy directly. It's a nice security feature to have. 2. Low brokerage fees. Moomoo charges $3 per share, which is among the cheapest brokerage fee in Australia. And the great thing about Moomoo is, since they are still relatively new to Australia, they are still offering new investors like yourself a nice sign-up bonus because they want your business. Right now, if you sign up using the link in the description, you will receive up to 10 free random stocks, $2,000 brokerage-free cards for both Aussie and US stocks for 30 days, which basically means your brokerage fees are free for the first 30 days. 6.8% annualized interest on your uninvested cash for up to 100k. In addition, the Moomoo app provides numerous free learning guides on investing in the stock market. This makes it ideal for beginners interested in investing in ETFs without incurring excessive fees. However, please note terms and conditions do apply, so make sure you check it out before proceeding. And honestly, I'm not sure how long this offer will last. If you're interested, use the link below to sign up and claim the free rewards on screen. The sign-up process itself should only take a few minutes. Enjoy. Emerging markets. A common criticism of this two-fund portfolio is the lack of exposure to emerging markets. It is true that VGS focuses on top companies from developed countries, which means you're missing out on emerging markets like China, India, and Brazil. However, while these markets have the potential to outperform, they also carry a higher risk of underperforming due to their developing status. Therefore, your decision to invest in these markets should align with your risk tolerance. If you're interested in gaining some exposure to emerging markets, you could research ETFs like VGE, IEM, or EMMG. For example, VGE is a Vanguard ETF offering exposure to over 4,000 companies from emerging markets such as China, India, Taiwan, Brazil, and others. Although its management fee of 0.48% isn't the lowest, it does provide a simple and relatively low-cost way to diversify into emerging markets. You can decide for yourself if you want to allocate a small percentage of your portfolio to one of these funds. Personally, I do have some exposure to emerging markets, but it's a more speculative investment. In my opinion, you are already sufficiently diversified with just the VAS plus VGS combo. Another criticism of this two-fund portfolio is the currency risk associated with VGS, which is domiciled in Australia. The performance of the Aussie dollar can impact the fund's performance. This means if the Aussie dollar outperforms other currencies, VGS would underperform compared to the identical counterparts in other countries. It's not necessarily that the companies within VGS aren't performing well. Instead, these companies are valued in their native currencies. Therefore, if the Aussie dollar strengthens against these native currencies, it could theoretically lead to VGS underperforming. However, historically speaking, over the long term, this will likely average out. If you're concerned about this, you might consider VGAD, which is the hedged version of VGS. This essentially removes the currency risk with a higher management fee of 0.21%. If the Aussie dollar outperforms, then VGAD will rise with it. However, hedging introduces its own currency diversification risk. By investing in VGAD, you're essentially placing all your eggs in the AUD basket, because you're already invested in VAS. As an Aussie, your job likely pays you in AUD. You may have an AUD savings account, an Aussie property, some Australian shares, and super. All these are highly concentrated in Aussie dollars. If the Aussie dollar underperforms, all your assets will also underperform by default. At least if you had VGS, there would be some upside. Please keep this in mind when considering hedged versus unhedged. Let's explore some alternative ETFs you could consider investing in. VAS plus VGS is not completely set in stone. You don't have to stick to these specific ETFs if you don't want to. In fact, they don't even have to be Vanguard ETFs. I'm using these two as an example because of their popularity within the Australian finance community due to Vanguard being a trusted brand. There are other combinations of ETFs, not just from Vanguard, that you can invest in for similar results. For example, BetaShares offers A200 as an alternative to VAS. Another option is IOZ, an ETF provided by iShares, which is owned by BlackRock, an even larger company than Vanguard. Both these ETFs cover the top 200 Australian companies compared to the 300 companies included in VAS. In terms of performance, the 5-year average annual return is similar at around 8%. The management fee is 0.04% for A200 and 0.05% for IOZ, which is slightly cheaper than VAS. However, VAS does include an additional 100 smaller cap companies, which offers more diversification. Alternatives to VGS includes BGBL from BetaShares and IOO from iShares by BlackRock. BGBL features approximately 1,500 of the largest companies from developed countries, excluding Australia. Like VGS, it is dominated by the US market, which makes up over 72% of the fund, followed by Japan, Canada, Britain, France, and other developed countries. The management fee is 0.08%, which is a bit cheaper than VGS. However, BGBL only launched in May 2023, so there's no historical data to assess its performance. Nevertheless, it should deliver returns similar to VGS as they track very similar countries and companies. IOO, on the other hand, includes 100 of the world's largest companies, including those from developing countries like China. Although not a direct like-for-like replacement for VGS, IOO does contain many of the companies that make up a large portion of VGS. The management fee of 0.4% makes it slightly more expensive than the other two. So there are a number of combinations you can play with. It doesn't have to be all Vanguard. You can mix them all around depending on what you prefer. If you're an investing minimalist, you might prefer a single ETF tracking everything to keep your portfolio simple. In this case, you could research something like VDHG or DHHF. VDHG is a Vanguard ETF that tracks the entire global stock market, among other assets. The breakdown reveals it's essentially an ETF of other Vanguard ETFs. It contains 36% Australian stocks, 26% international stocks, 16% international shares hedged, 7% international small caps, and around 5% for emerging markets. However, 10% of the fund is invested in bonds and cash, which may not appeal to everyone, especially younger investors. The management fee is a bit higher at 0.27%. Similarly, DHHF is another all-in-one ETF by BetaShares that tracks the global stock market. The breakdown includes 36% Australian, 39% US, 18% developing markets excluding the US, and 7% in emerging markets. With a cheaper management fee of 0.19%, it essentially ticks all the boxes for a high-growth ETF. The only downside to both VDHG and DHHF is the preset allocation. So you can't control the allocation if you wanted less Australian and more US stocks or vice versa. However, with a two-fund portfolio set up like VAS plus VGS, you can adjust the balance over time by buying more or less of one fund. Quick disclaimer, I'm not a financial advisor and this video is not financial advice. The ETFs I mentioned are not buy recommendations and are examples only for educational purposes. Please remember, just because an ETF has returned a certain percentage in the past does not guarantee it will continue to do so in the future. Please do your own research or go see a professional if you would like financial advice. Portfolio allocations. So how much should you allocate to each fund? Should it be a 50-50 or a 80-20 split? Honestly, this depends on personal preference. There are no set allocations for these funds that you must strictly follow. However, many investors generally allocate more towards VGS as it represents a larger portion of the global market. As previously mentioned, VAS Australia only covers about 2% of the entire global stock market. For diversification purposes, it might be sensible to have more international exposure. From my research, many Australian investors in the finance community opt for a 70-30 split, while some go as high as 90-10 split. Your allocation should depend on your risk tolerance and your confidence in Australia versus the rest of the world. By the way, if you're enjoying this video or found it useful, comment the word peach down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this awesome community. Also, be sure to sign up to my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, and any cool life updates from me. And if you're interested to learn how to buy your first ETF, then check out this video on screen where I'll give you a beginner's guide on how to buy your first ETF in Australia. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.